The financial system is filled with constant and never-ending risk. When a crisis occurs and the risk is exposed, it's only a matter of time before another much bigger risk appears. It can be covered up for a long time, but invariably all dangers eventually show their true self. Because the financial system is so intertwined, there's no way to avoid a crisis if one component fails. Are you ready? You came here for the truth, so let me unveil that for you. Today we're going to look at Wall Street's riskiest loans. I want to talk about Janet Yellen, everybody's favorite. I want to look at the mortgage rates. I want to touch on many subjects today, and I want to begin with this. We're talking about more than $2 trillion in this particular market for leveraged loans and junk bonds, and agencies including the Federal Reserve can't do much about it. Well, this is out of Bloomberg. There's an article here that Janet, the felon Yellen, was actually quoted in. So of course, anything to do with Janet Shake It Yellen has to be discussed, so I bring it to you. That's because some of the most aggressive financing is being done outside the traditional banking sector. Regulators should sound the alarm. That's according to Janet Yellen herself. That's a quote. They should make it clear to the public and the Congress that there are things they are concerned about and they don't have the tools to fix it. That is a very important thing to understand. What's being said here in this paragraph is not understood by the general public. It is not understood by those in the financial system, and the Federal Reserve understands this, but they will not discuss it. Why? Because it's very, very political. Keep everybody happy, keep the sheep asleep, all right? If regulators can't maintain safe standards, it's not just Wall Street's over-leveraged corporate clients that might be at risk, thousands of jobs at stake, because the companies might start defaulting on their loans. Now, watchdogs don't see any perils from leveraged loans that could threaten the financial system the way the collapse of the housing market did a decade ago, and surely it's not as bad as it once was. However, it doesn't matter how big the problem is, it's all a matter of dominoes falling. One leads to another, leads to another. All we need is a trigger event. The market is much smaller, and any excess of borrowing is concentrated among companies, not millions of U.S. households. Of course, we see this time and time again, the failure to understand how this really works. Everything today is intertwined, and it doesn't matter if it's coming from U.S. households or a few corporations. It's going to be a domino falling. Where it starts, nobody knows. But we know that eventually it makes its way around. Banks are also much better capitalized than they were before the crisis. That is a fact. However, it is not a fact that they have enough reserves. They have enough capitalization. It is an absolute fact that they are still over leveraged. But of course, everything is just fine. Now you can see on the chart right here, more deals done outside of the regulator's view. Leveraged loan market share is jumping for every case. You can see what has happened here clearly, and this is no different than everything else. We've seen debt expand, leverage expand, margin expand all throughout the past several years since the financial crisis. Now this is a very, very important chart. We're looking at the relative momentum index, and it shows us something that is quite interesting. You can see that leading up to the financial crisis, leading up to the dot-com boom, we see the exact same patterns forming as today. Now this right here shows us second high took place on September 1st, 2000 with falling momentum. And this right here, second high took place on October 12th, 2007 with falling momentum. And looking at this, how it basically shows us the potential for this to happen again. Whether or not it will, I don't know. But according to the Relative Momentum Index, this is something that we need to be very, very careful about. The same things occur over and over again, and patterns repeat. They may not be exactly the same, but they tend to have this repetitive pattern. Now, there's always an event, there's always a trigger that is taking place, and it seems to be that every time it's something different. So I don't necessarily think it's going to be subprime mortgages, for example. It could come out of nowhere, and that's usually how it is. Everybody's looking in one direction and the problem arises in the other. Okay, so this is something I think you should keep an eye on. Number of Russell 3000 companies trading for more than 10 times their revenues. So we look at small caps, we look at the blue chips, we look all around and we see the same kind of behavior, and that is things are very, very overvalued. They are more overvalued today than they were during the financial crisis, and this other peak that you're seeing there is during the dot-com boom, of course, where we saw these super exaggerated PE ratios and other numbers right there. I'll move on. David Rosenberg had this to say on his Twitter. The FANG Plus, as I call them, stocks have seen their market cap share triple to 17%, eerily similar to the late 90s when these tech companies saw their share peak at 17% as well. Look at what happened next as the Fed, who helped create the bubble, destroyed it in the ensuing rate hike cycle. That's what we talked about all on previous videos, and I will continue to do so here, and I've got something to mention in the next article. But you can see that the chart on the left hand side is the present day, and on the right hand side that is the dot-com boom and then the bust on the way down. Is it going to be the exact same? I don't really know, but usually the bigger they are, the harder they fall. So I wanted to show this to you. I think it's very important. Not necessarily, doesn't even make a difference what David Rosenberg says. It really doesn't. Look at the actual charts, understand what had happened last time with the excesses, and are we leading into the same thing? Many people say no. Well, we're going to see. Time will tell. U.S. 30-year mortgage rates hit a 7-year peak. That's according to Freddie Mac. And this is one company that I think is funny because their brother and sister, Fannie and Freddie, having trillions of dollars of their garbage put on to the backs of the taxpayers. This was after the whole housing collapse that we saw. Today, however, we're looking at this mortgage rates extending to a 7-year peak as the mortgage rates had come down. That allowed all of these different companies offer cheaper prices. The investors, the home buyers started to get in, purchasing homes, feeling more confident, and so they did this. As a result, you have these prices obviously astronomical today. Now they're showing us an average of 4.72% right now, but this could easily get over 5%, and then it becomes worrisome. And this is from an average point of view. If you have worse credit, you're obviously going to have to pay higher rates. Those are the people to more likely be delinquent, and that will, of course, have its own domino effect. All right, now we're talking about China here, just very briefly, talking about a report out of Bloomberg. They noted that from June 2015 through the end of last year, the 100 city price index rose 31% to almost $200 per square foot. That's nearly a 40% higher than the median price per square foot in the US, where the per capita income is more than 700% greater. They suggest that most of these apartments, they're empty right now. All right, so that's something that really distorts the market. I hate to see this because you have investors in there and they're waiting for appreciation, where real estate makes money in 4 different ways, One of them is appreciation. In fact, that's the worst way to look at real estate. You want to be making, number one, from passive income, from the rental income. If it's sitting empty, you're simply just waiting for someone to come in and buy it up off of you at a later date. Looking at this here, you can they get into the details, rental yields, and so on. Since household real estate lending is 22% of Chinese banks' assets, what are you going to do? Are you going to slow this market down, or do you simply look away? And last but not least, I want to cover Argentina very quickly. This has been fluctuating. Their currency dipped below 40 to the US dollar. It went back up to about 37 or so. It's been fluctuating within this range over the last 30 days. That's what you're seeing here on this chart. I really think it's going to get worse. This is an article here talking about the situation in the more poverty-stricken areas of Buenos Aires, looking at the people struggling. I've had more and more people over the last few months. Prices are increasing so quickly that they're struggling to buy basic foods such as milk, pasta, or sugar. So inflation is going to be about 40% this year, they claim. People don't have the money to buy food and so on. I've heard people say everything is just fine. I don't know what you're talking about, but somehow I feel that there are really, really big gaps in between the haves and have-nots, and that is really separating out. If you're earning income outside of Argentina and you live in Argentina, you're probably doing very, very well right now. I don't know how the internal markets are reacting. Are the food vendors increasing their prices very regularly, daily, weekly? Are the restaurants printing out on pieces of paper because tomorrow or next week the prices will be much higher? How they're all dealing with this, I'm not there, I can't tell you, but I know from many people I have heard from, the struggles are real. They're not Venezuela level, obviously, but it's getting quite bad. So I'm going to end it there. I'm going to keep tracking this, so you will hear more information from me in the future, definitely. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. If you want to give Janet Yellen a thumbs up as well, you can do that. And last but not least, if you found the video informative, I know you'll find my books even more informative. You can check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.